So anytime you're looking for a breakout, you want too many longs to stack the other way. You have to understand that after someone gets long, after they're long, they have to sell it to exit the position. So they become a seller. What do you need for a price of anything to go down? You need sellers. More sellers, better chance you have to go down. So why not find more longs? Well, we do. We find more longs. First of all, you look at the bottom of this as being a breakout of the low of a range or a consolidation. And then what do you see in our OPP? OPP is other people's positions. This is the sample size of other people's positions. If you don't know the value of other people's positions, stop trading. Close your account. So let me back this up a little bit. And it's all about probability. And you get more green over here than red here, you have a probability to go down. And then when you get a lot more green like this with these white, what these white bars are, lines inside the green, are offers, sell orders to get out of the long. The green represent the longs. The white represents an offer to get out of the longs. That's a really high probability, not upside, downside. And then you get it. Flip your thought process. Most people understand that there's a high failure rate in day trading. So don't think conventional wisdom. Know what conventional wisdom is and flip it. Most people want other longs and other buyers when they're long. You want the least amount of longs or competition when you're long as possible. You want a lot of longs when you're short because that's what creates the selling to push us lower. But if you don't click that after a person's long, they become a seller, then everything else that helps you predict price is not going to make sense. You have to start with why price moves. If you can't explain why price moves, you have no business predicting it. So that breakout had a probability stack to it, which strips out randomness. Here, instead of here, any fifth grader down here could say it's going to break out through there. It's already broke out through there. What stacks probabilities to give you a better chance at being on the team to get trades to go your way ASAP? Because most people will get short when they should have already been short, get long when they should have already been long. They're late. They reach. And if they're lucky, there's another leg lower. But generally, they get shook out, then it goes. So in here, they don't get short there, but they wanted to. They end up getting short down in here. They get shook out and take a loser, and then the market might continue down. So they had the direction zeroed in, dialed in, perfect, and they have nothing to show for it. In fact, they have less to show for it. They were right, and they lost money. Or a lot of people put themselves in a position where they accumulate a little bit of money, 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 and then wham, they take the big loss that wipes away all of this and then some. And the reason is because it was just random in the making of the money. It was just random. Too much effort. Market allowed you to get away with mistakes. And then you're going to come to that day where the market doesn't allow you to get away with the mistakes, and it's going to clip you. And you're like, where did this come from? You have to understand the value of other people's positions. If you don't, you're in the wrong business. You really are. It's like you want to be a surgeon, but you don't believe in the value of a scalpel. So get your eyes around congestion and what it's going to take to stack probabilities to make predictions, or else everything's going to remain random to you. And you're going to be looking for magic bullets. The magic bullets is a high stack of probabilities, what should happen, and then knowing what should happen. If it's not happening, there's an edge in that too. Start reading the market by reading other people and forget about what you think. Think about what the market's thinking.